Hi, everybody. Welcome to another episode of the 7-Minute Takeover, where we chat all things acquisitions. We're your hosts. I'm Liz Prey.
I'm Eamon Gamble.
Today, we're discussing overcoming a common objection, and that is inconsistent earnings in the company. So, Eamon, walk us through what is the first thing that we do when you identify that there is inconsistency year over year, or even you've just got the interim financials and all of a sudden you see a dip in the earnings and you go, no, what now? What's the first thing to do?
Yeah, so when we're talking in the lower middle market, we're not really discussing a change of 10, 15% here. Those are usually pretty mitigatable and pretty normal. What we're talking about is when there's maybe 50% swings in earnings. It's 1.5 million one year in EBITDA, the next year is 750. The first thing that you're going to want to do when you see a business like that is you got to understand the story. There could be a number of reasons why something like that has happened. The loss of one key client that had a really profitable contract could lead to that type of shift. A regulatory change, a new competitor enters the market, a key salesperson leaves the company and goes to a competitor. There's any number of reasons why something like that could happen. And so in the back of your mind, you want to try and decide, was this a one-time event that is not expected to recur? Or is this just inherent volatility in the business? You could think of something like oil field services, where the price of oil is going to heavily dictate the level of business an oil field services company generates. And so that's really outside of the control of the company. Whereas, that one key customer lost, that's something that may be more one time. There may be an explanation behind that. So you really want to understand, was this standalone issue, or is this just the business you're buying into?
Okay, so be a bit of the detective, dig in, find the story, find the reasoning behind it. And so how do you work to evaluate this explanation that's now been provided to you to understand, okay, is this something we can work with meaningfully, or is this a no-go decision?
Great question. So it's you said detective, I'll say scientist. You've got a hypothesis. You're going to test that hypothesis. You may need additional information from the seller beyond just what you would normally ask for if there wasn't that type of dip in cash flow. You may want to understand more things like, what are the contract terms? What are the cancellation clauses for some of those bigger clients? What are their clients really buying based on? Like, if you're able to go speak with somebody, maybe not their customer, but maybe somebody else in that industry, like, what do they look for when they're making the purchase from the company that you're buying? There could be other ways, but it's usually going to involve asking for more documentation. One thing I really like to do when I see a bit of volatility is extend the timeline. So if you go back, maybe you've got 3 years of financial history, go back 6. You'll see, okay, yeah, it was very stable for 4 years, and then there was a one-time fall off. That might validate the seller's claim that it was a one-time event.
Okay, so you really want to make sure as well that is this recoverable? Can you mitigate this? Is it going to happen again?
Is the knife still falling?
Yeah.
You may not want to catch it at that point in time.
No, then it's a walk away. It's a walk away for sure. But some further evaluation certainly required. Okay, and so how is this going to impact the deal structure or the value of the company in these situations?
Yeah, great question. So let's say that we've determined that it's just a volatile company. It's in an industry where there is volatility. If a business is more volatile, that means it's higher risk. Risk in capital markets is typically dealt with by lowering the multiple that you're paying on that cash flow. So the simplest answer, your seller may not like this one, but the simplest answer is bidding at reduced multiples. So if you determine that, the average cash flow over the last 3 or 4 years is that $1 million or so, maybe you're only applying a 3 times multiple to it instead of 4 times. That's the cleanest way to do it. Now, some sellers may not be open to that. And
Many.
all.
But
So that's where we get to deal structuring. And so there may be ways to say, okay, you're saying that it went down to $1 million, but it's going to go back up to $1.5 million next year. Okay, well, maybe that means that there's an earnout attached to that, or some type of contingent compensation where they're going to make some of that purchase price if they actually, if the company comes through on what they said it would do. It could even just be as simple as more seller financing. You know, if the seller does have more skin in the game, they're going to work harder to make sure that you get that they get their seller financing paid. You know, if that seller financing is contingent on reaching a certain level of activity, even better.
okay, so you can put in some more parameters around how that seller financing is paid, or instances where it's not paid if something doesn't come to fruition.
That's right. Yeah, you just want to protect the downside, that where the scenario where the business doesn't recover to the levels that it was claimed to be without going underwater on say debt servicing or cash flow.
Absolutely. Okay. So there's always another party in the deal, in most deals anyway, and that is the big L. That's the lender. And so, yes, I went there. And so, how does the lender look at these situations?
You know, sometimes the lenders will, sometimes people in these situations may get a little frustrated with the lender, but the way that they typically look at it is often what's best for the buyer from a safety perspective. And that just means they're typically going to offer less. So if in a, call it standard situation, a lender may offer 2.5 times EBITDA as a senior loan, they may look at this and say, you know, we're just not comfortable levering the company up to that degree, at which point, you know, if you do have an off year, like I said, you're going to be underwater on debt servicing. Like, we don't want to put you in that position, knowing that this is inherent to the business. And so you may get offers that are just lower in terms of loan to value, 1.5 times, 2 times EBITDA.
In terms of a conventional loan.
In terms of a conventional loan. And so they're doing that because they want your company to survive. They only make money if they get their money back. And so, you know, it can be a reasonable position for the lender to take. You know, as the buyer, and you're looking at a volatile situation, you also want to just have a rock solid plan that if the company performs lower than expected, you know, we all know about the J curve. First year's probably going to be tough anyways. If you combine that with a, you know, poor macroeconomic situation that results in a poor year for the company, you as the buyer need to know, okay, what am I going to do? Do I need to inject cash? If so, where's that cash going to come from? And so if you have as low as possible debt servicing costs, that situation is just going to be a lot easier to deal with.
Okay, so bank comes in with less, then you've either got to come in with more equity, or that's where the higher seller financing portion comes in to make it work.
You got it.
If the valuation doesn't come down.
Because hopefully you're probably holding a little bit of equity back for that rainy day.
Yeah, exactly. Okay, so first of all, we want to determine if it's a no situation. Then we're going to evaluate, get the story, evaluate deeper, adjust purchase price, or adjust the deal structure, essentially, is the summary of.
Yeah, and just be maybe a bit more conservative in your expectations from the lender side.
Sounds good. All right. Thanks very much, Eamon.
We'll see you later.
Take care.
Thanks for tuning in. If you enjoyed the content, please be sure to subscribe, follow us on social media, and check out our website at villagewealth.com.